This is Beyond the Resume, the podcast that brings you the stories, advice, and insights behind some of the most successful people in real estate. Beyond the Resume is brought to you by Jackson Lucas Executive Search, the industry leader in human capital solutions.
So welcome to the Rural Housing webinar. I'm Kristin Niver. I'm an attorney at the law firm of Robinson+Cole with a focus on affordable housing finance and other impact finance transactions, primarily clean energy, representing CDFIs and green banks. And I'm happy to be here, and I will turn it over to my panelists to introduce themselves. I'll start with Brian.
Very good. Brian Depew. I'm the executive director at the Center for Rural Affairs based in Nebraska. The center engages in policy change, capacity building, and capital access across a set of relevant priority areas for rural people in small towns. The Center for Rural Affairs is a 50-year-old organization, but just in the last 5 years has started to build out capacity in rural housing, capacity in financing, and happy to be here and looking forward to the conversation.
Great. Thank you, Brian. Now I will turn it over to Tom.
Yeah, hello, Tom Collishaw. I am the CEO of Self-Help Enterprises. We're a nonprofit housing and community development organization that serves a large area known as the San Joaquin Valley in California, home to many of our crops and farm workers and various needs related to that. Good to be here.
Thank you. And Sarah?
Hello, everyone. My name is Sarah Kackar, and I'm the Senior Director of the National Rural Work as well as National Factory-Built Housing at NeighborWorks America. We are about the same age as Brian Depew, almost 50 years old, and we are a congressionally appropriated national nonprofit intermediary. So say that 5 times. We have a network of about 250 high-performing affordable housing developers and community developers and economic developers around the country. And in Puerto Rico, we're in every state, the district in Puerto Rico. And our mission is really to create communities of opportunity through grant making, technical assistance, training, peer connections, all across the spectrum of housing, community development, leadership development, and board governance. So thank you so much for having me here.
Thank you, Sarah. And Nadia?
Hello, everyone. Happy to be here. My name is Nadia Villagran. I'm Vice President at Local Initiative Support Corporation, and I lead LISC's rural program, Rural Is. I think I'm the youngest in the sense of words, because I know Self-Help Enterprises up there in the years as well. We've been around for 31 years as the rural arm of Local Initiative Support Corporation. And much like my colleagues on this panel, our focus is really tied to rural community and economic development. That is created in the form of capacity building services to our 200 or so nonprofit partners across rural America. Our footprint includes the continental U.S., as well as the U.S. territories, Puerto Rico, and Guam, and U.S. Virgin Islands as well. We support 5 priority markets tied to housing, access to capital, broadband and infrastructure, small business supports, and then workforce and financial prosperity. And I'd love to share more about that in detail as we have this conversation, but I'm happy to be.
Thank you so much, Nadia. As you can see, we have a really incredible group of panelists, and I'm excited to get this conversation started. So I think I want to start out by just sort of setting the stage of the rural housing landscape before diving in to finance and policy. So I want to open it up with a question to Brian to talk about having spent your entire career really working in Nebraska. If you could sort of spell out how rural housing differs from what people focused on urban markets might encounter, and sort of what would you tell the audience that they don't already know about sort of issues that rural communities face, and if you could pull in any examples that sort of illustrate certain challenges.
Sure. I mean, I think one of the things, the need is significant across all of rural America and all rural communities, all of rural Nebraska. But when you start working at individual projects or individual communities, the scale that you're working at is like strikingly different often. And that can result in increased costs and less efficiency. And I think we kind of all know that. But it actually affect projects, I think, in ways that are even more interesting or nuanced than that. We are working right now, for example, on financing for 3 small housing developments in 3 small communities in rural Nebraska. And these communities, one of them has a total population of 8,000 people. Another has a total population of 6,000 people. Another community has a total population of 2,000 people. We literally know every single buildable lot in each of those 3 communities. We know more or less all of the relevant actors, all of the relevant people in the city government or economic development, all of the developers who have built in those communities, because it's not that many people. There's like, 3 or 4 or 5 people and literally 5 available lots that can be built on. And so, that presents opportunities, but also challenges and capacity challenges and how you implement a project. And we end up playing kind of an interesting convener or orchestrator role to bring a project together when there's not a lot of the capacity organizations that might exist in a larger market. We set out to be a financer, but we end up kind of being an orchestrator of the project. So I think that's one of the things that's different, related to that. It's very easy to overbuild. Even sometimes 3 or 5 units can overbuild in a particular market. And then the other thing is that there are really interesting opportunities for rehab, really deep rehab. There's oftentimes dilapidated properties. We recently made a loan to a contractor who does really significant, they're buying houses that are buying them for $20,000 or $30,000. Many people would say they ought to be torn down, but they are doing really deep, effective rehab and rehabilitation and creating market rate housing out of them. But there's not very many people that work in that space, even though I think there's opportunity for it amongst the infrastructure.
Great. Thank you so much, Brian. I want to turn it next to Tom to talk about his work in the San Joaquin Valley. So as noted in your introduction, self-help has been working in this region for over 60 years. So I wondered if you could kind of talk about the work that you've done, that the organization has done over those 60 years in one of the most agriculturally productive regions in the world, and also a region facing deep poverty and severe housing shortage. So what does the paradox look like on the ground today? And I'm hoping you could talk a little bit about how the farm worker housing situation has changed or not changed over your decades of work.
Yeah. Thanks for your interest in that. We pioneered a mutual something that's called the Mutual Self-Help Housing Program over 60 years right here in the San Joaquin Valley, and that's where people, mostly farm worker families, we put them in groups of 10 to 12 families, and they share labor to build their first home that they own. Like any homeowner. We saw that as a need early on, and now 60 years later, we've done nearly 7,000 of those units with all low and very low income families, not exclusively farm workers, but that's been a big part of the participatory group in that program. But we have also found over time, and as Brian mentioned, we have severely deteriorated housing stock, much of which was never built to any code to speak of. So we decided we needed to be involved with people who mostly own their units and need them rehabilitated. And so we've over the years, we've worked with city and county partners in our region and the state of California to garner both federal and state resources to rehab almost 8,000 units of housing. And then subsequent to that, we were kind of built around home ownership, but we realized that there were real gaps in affordable rental housing opportunities in the Valley. And so we started doing that work in earnest, really in the 1980s. Subsequently and more recently, we've also gotten into the special needs aspect of rental housing, including formerly homeless folks and seniors and Native Americans and a number of different user groups. So we now own and operate over 3,200 units of permanently affordable, I like to say, rental housing. But one of the other key things I would say for us has been getting involved in community infrastructure, because in rural towns, you can't build anything of scale unless you have sewer and water accessible to those communities. And I think that's one of the big differences than some of our urban counterparts, is they think about the fees maybe related to getting water or sewer to a project, but they don't fundamentally think about whether you can get sewer and water to that project. So we have an active program, and have for more than 50 years, on just developing small water and sewer systems so that we can build in these rural communities. And so I would say on the farm worker housing side of things, that the biggest single change that we have seen has really occurred in the last 25 to 30 years. And that is that predominantly our farm worker population now is undocumented. I've seen estimates as low as 60% of the working farm worker families to up to 75%. And that creates real issues in general, because certain federal funding can't be used to house those people. They can't participate in some of our traditional home ownership programs, for instance. But you add that to the current administration's approach to immigration enforcement, and you just have people that are afraid to go out and literally go shopping, let alone seek a housing opportunity from someone like Self-Help Enterprises. So that change in our workforce has been the biggest change that we've seen.
Thank you so much, Tom. I want to turn it now to Nadia to kind of zoom out to the national scope and what Rural LISC sees. Rural LISC has invested in more than, I think, 2,500 rural counties in almost 50 states. You can correct me if I'm wrong, but so could you kind of speak about certain patterns that you've seen that maybe don't get enough attention, and what rural communities are doing that can be replicated and scaled? Also, you've talked previously about rural communities as sources of innovation, and I love that. And I'm wondering if you can give us some examples of how rural communities are innovative in ways that folks working in urban centers may not consider.
Yeah, I appreciate so much that question. I also appreciate going after Brian and Tom, because they showcase some of that innovation, right, in what they described in Nebraska and California. I mean, the point really is that when you're in a rural place and you know everybody, or you have this very clear identified need, you have to be creative enough and innovative enough to come up with the solution that highlights all the strengths that this rural community has, right? And see it as an asset. And so, for example, the Mutual Self-Help Program, which Tom knows, and of course I'm going to plug, I happen to be a product of that program. My parents built their own mutual self-help home when I was 7 in Arizona under this program. It's an incredibly innovative and forward-thinking model that relies heavily on the natural tendency in rural communities of people wanting to help each other, right? Wanting to put the walls up together to get these houses built for themselves and their neighbors. And so it's seeing that lack of skilled labor that's an issue in rural communities, but recognizing that we have just a lot of people want to help each other, addressing that lack of skilled labor to get these houses built. And that 60-plus-year-old program has been extremely successful across rural United States, supported by USDA because of that innovation. And it just snowballs from there, right? The idea of recognizing that a developer can't just be an affordable housing developer in the sense of homes built and rental units built. They also have to build infrastructure, and they have to understand what public resources are available and what timelines are restricted within those public resources to put water and sewer and what we do too, broadband and high-speed internet into the planning process for affordable housing. And just this idea that in rural communities, you have to think of everything and you have to talk to everybody and you have to use the brilliance and tenacity that exists in rural places within rural community members to get the work done, right? And so everybody knows each other, so that's an advantage. Everybody knows each other, so that's a disadvantage. And then and you work through it. And so we've seen that in many ways, in the way people respond to disaster, right? The idea of rural communities face disasters in an extraordinarily tragic way. And oftentimes they're disasters that don't get public attention, but the community comes together, they find all of the tools that they're going to need. And for example, in Puerto Rico, when Maria hit, one town had really incredible land mover equipment that they just let every other town borrow to get the communities cleaned up. Not because there was some organized structure, because FEMA came in to fix that structure. No, because they knew each other. The small rural parts of Puerto Rico knew each other, and they knew that they could borrow the machinery from the town over to get things done. And it's this idea of collaboration and innovation and not being afraid to ask each other for help and for guidance. That's the other part of the Rural Is Network. We are an organization that supports about 200 nonprofits, as I said. And oftentimes there are nonprofit groups like Tom's group, Self-Help Enterprises, that knows everything. Let's just be frank. They've done it all. They've seen it all there in California. They've had to test every single challenge that exists. And they're willing to share what they've seen and they've learned, and they're tested models with other groups in Nebraska, in Maine, in Mississippi, in Alaska. And that's been an incredible way that rural communities have stayed in their state and been able to scale good ideas, because one group who's tried something is willing to share their highs and lows in that process with others in a network and have, that shared openness to problem solve. And so I'm not even sure if I answered the question, but I know that what we see in rural places is just incredible willingness to work with each other and then highlight innovation and scale it out in a tweaked way, depending on the rural place. But it's a very I would say that it's one of those things that keeps you going, right? When the times get tough, when the challenges get complicated, when we're dealing with unclear changes in public funding guidelines, there's this collaboration to all share how we've used public resources well to then help, re-identify the value of public funding, private funding, and all of the above. And so it's a shared momentum forward.
Yeah, thank you so much. That's very interesting and helpful. And I want to kind of wrap up this sort of laying the groundwork session with Sarah to kind of highlight the diversity of rural places and to also speak to the preservation gap. NeighborWorks, I think, has over 120 organizations in its network, or maybe more. Sarah, you can clarify. But I've heard you emphasize that rural is not monolithic. So the challenges in the Great Plains are different from the rural South, are different from, rural places in the Southwest. So can you talk about how diversity kind of comes into play when practitioners are designing different products and programs? And then secondarily, you've talked about preservation as a supply issue. So could you speak to what's at risk in the rural housing stock right now?
Sure. And I love following everyone here because it sets a little bit of context for our conversation moving forward, but touches on the same pieces. So our network is about 250 organizations, but 120 of those, so you were right, Kristin, are focused in on rural. However, when you look at the whole 250, 80% of our network touches rural in their service areas. So even if they're urban domiciled organizations, they extend out into rural. So you're right that rural, when you've seen one rural place, you've seen one rural place. There is a vast difference across this country between the density in a place, how remote something is, how big it is. It could be 500 people, it could be 20,000 people, it could be an hour from a major city, it could be 4 hours from a major city. And so just understanding not only the geographic conditions of a place, but the demographics within a rural place and part of the country, even a region of the country, can differ dramatically. So the conditions and the considerations and the communities we're working with in Tom's area in California and his service area could be quite different in many ways from some of our groups up in the northern borders of New Hampshire. So there are different economic conditions in each of those specific states. There are different laws, land use laws, development regulations in each of those states. Some states are home rule. I think we've got quite a few lawyers here on today. We have some home rule states and we have non-home rule. So everyone's local enabling environment, their state enabling environment is very different that they're working under. And that's what really leads to some of that diversity that as we're considering working in community and letting those community and resident voices lead the work, we really are looking at all of those different factors, what the economic drivers are, what the community drivers, social structures, and history are of those specific areas. But I think to the earlier points, that Brian and Tom were making about preservation and rehab, we definitely, I know at NeighborWorks, and I know all of our panelists, my friends here today, really agree that preservation is as much a supply issue as building new. The history of sort of how we got here is, nearly almost a century long history of definitely the federal government recognition of the housing stock in rural America and the supply and the condition of it. And so that is why over the decades, there have been programs to really assist in rehab as well as building new. But the economics of those different places I just mentioned and the economic change over the last almost 100 years has really made many of these rural communities, it's been really tough for them to weather the shocks of some of these economic highs and economic lows. So perhaps it's natural resources tightening, it's plants closing. All of these shocks can impact a rural area. So very differently than in the cities, when we look at some of our rural communities, it's just as if some housing over the years of not being able to be repaired, if a plant closes and just the town is just absolutely sort of in different stages of losing population, then housing stock hasn't been able to be maintained. And so then you're losing value on housing stock. And so what we really look at in many rural areas too is folks who may not have the jobs or the economic opportunities that pay as much to be saying, oh, I just want to buy a new house. Even putting on a new roof, rehab projects at the small scale at $5,000, $10,000, $15,000 can make a previously uninhabitable structure, it can make it habitable. And I think that really speaks to a lot of the great work that Tom's organization and many others in our network and Nadia's network are doing on the ground. Because when money's tight and when it's not there to buy a whole new house, if there are still parts of that we can focus on preservation or rehab, it's critical. And that's just in the single family and in the multifamily space as well. Decades ago, about 30 years ago, there were portfolios of multifamily housing that the federal government had really put out for low interest mortgages. And those mortgages have been starting to they're coming due and they're basically aging or sunset out of affordability and going back onto market rent. And so that is a huge crisis in terms of preserving the existing multifamily in rural, which some people might say, what's multifamily look like in rural? It doesn't always look the same. It's maybe not a tower. It's sometimes not 2 stories, might be just 1 story. But the point is that it's really critical that we look at programs out there and we look at rural communities and saying what kind of housing already exists and how can we preserve this through rehab or through different financing structures, in addition to the ideas of attracting developers, whether it's nonprofit or for-profit, into building new.
Thank you so much. So now I want to move to talking about capital stacks and how rural housing is financed. And I'd like to start with Tom to talk a little bit about the role of both USDA and also the GSCs, if you could. So could you kind of spell out some of the core USDA programs that still help get rural housing financed? And then maybe walk us through like a typical self-help enterprises deal and kind of what we would see in a capital stack. And then I wondered if you could talk about the GSC's duty to serve, what it means for rural communities, and if it's actually meaningful capital or just aspiration.
Yeah. Yeah. And maybe I'll just take a step back for a second just to say why rural is different when it comes to financing. First, we're under-resourced. We have lower incomes than our urban neighbors, or certainly when it comes to California, our coastal neighbors. And that has a huge impact on the projects that we can build and maintain affordability. Because if literally our median incomes in our county, there's an adjacent county to us that touches saltwater that's twice as much on a median income. And what that translates into is $1,000 a month more affordability for somebody considered at the same income. So the same low income person could afford $1,000 more. And so think about the impact that has if you have a capital stack and you have debt to service and operations on a rental housing project, for instance. But to get to your question, it's one of the reasons that we end up relying pretty heavily on deeply subsidized programs like USDA. So in our single family mutual self-help housing program, we use something called the 523 grant from USDA Rural Development to provide technical assistance. So that's so we could put a construction superintendent on a site with 11 families to build their homes. And then we use what's known as the 502 direct mortgage. We package those loans for the individual borrowers. That's a critical program for affordability. And remember, this is both low and very low income households. And the reason it's critical is that it's a market rate interest loan for 33 years. Go figure, only the federal government does a 33-year loan. But the interest rate can be subsidized down to as low as 1%, depending on that family's particular circumstances. And that subsidy can exist over time, but there's a check-in each year with the family. And as their income approves, they eventually pay the full note rate, like any mortgage holder does. And ultimately, that money that was subsidized is recaptured by the federal government. So it's not a money loser to the federal government. The budgets for 502 has remained largely constant with some ups and downs for about 20 years. So we're only doing about half the homes in that program that we once did. It was less than 5,000 homes nationally last year because costs are going up. Our costs are going up just like our urban counterparts. And when it comes to prevailing wage, and many of our projects require prevailing wage, we get hit harder, I would argue, because we, especially in our rental projects that require a prevailing wage requirement, we're really not paying any difference than they pay in San Francisco for prevailing wage. So the net effect of that is crazy, because we are layering low income housing tax credits, and attracting investors is a challenge in rural communities unless a bank or an investor has a Community Reinvestment Act requirement to serve that area. It's sometimes hard in the more remote projects to attract investment. And then we are layering behind it typically some soft secondary sources, either from the state, from the home program, sometimes CDBG, sometimes National Housing Trust Fund. So our capital stacks for both our single family and our multifamily projects are usually run at least 4 to 5 deep. And it goes back to Nadia was talking about, you have to be creative, you got to be innovative. Sometimes you got to throw 8 pieces of spaghetti against the wall to see if any of them stick. And we're dealing in competitive environments where rural does not always compete as well as urban projects, because we don't have local resources. We live in the reddest part of the bluest state in the country, where we serve, and we don't tend to pass local taxation or bonds to assist, and so those are what becomes competitive for some of our urban counterparts. And separately, the state of California has decided that there are places that are more advantageous to develop than others. They call them high opportunity areas, and the metrics for those are really strained in rural areas. There, where there's better schools, there's more facilities, there's more support, there's more capacity. And so we tend to just struggle to compete for these resources.
Thank you so much, Tom. I want to turn it now to Brian to talk about the role of CDFIs in filling any gaps. CDFIs are intended to basically fill gaps and lend into deals that conventional lenders won't touch, basically. So could you talk about building a loan fund that works in rural communities and where the capital is coming from? And then, as Tom mentioned, CRA assessment is a big factor in how capital is attracted to rural communities. So if you could talk about CRA assessment areas and what constraints you've encountered in trying to attract bank capital to rural communities.
Yeah. Listening to Tom talk about the various programs that they have to patch together, USDA 502, CDBG, home funds, other state and federal funds, is like, that's the landscape. We see a similar landscape. And when we looked at that as a CDFI financer trying to figure out what can we do to be helpful, we decided to pursue a strategy of trying to raise private and philanthropic capital that's flexible so that we can come into a wide variety of deals, because Tom and other practitioners like him are already navigating the myriad of requirements, sometimes stacked on top of one another. And so the last thing we wanted to do is bring in capital that had yet another requirement. And then sometimes there's just projects that, like, they don't work within the constraints of one of the existing state or federal subsidized programs. And so we've been trying to raise private and philanthropic capital that is by design flexible, and by design can be deployed into a variety of projects: affordable housing, workforce or middle income, rental or for sale, different typologies, different income levels, to allow us to respond to different community needs, different project needs, different developer needs. And we've been somewhat successful in building an initial, equity base of philanthropic capital to do that with. And so the natural next step is, okay, we've raised some equity that we lend into housing development. We ought to be able to leverage that. And, I go to all the CDFI convenings, and I have heard, and I think I know that, well, what you do is after you build up some equity, you go to the banks and they lend to you because they have CRA requirements. So I started trying to do that. And I just wasn't having a lot of luck, and I couldn't figure it out. And as I got a deeper understanding of how Community Reinvestment Act works and how assessment areas work, when you're trying to work in, like we are, a broad rural geography, like the best we can do is if we get a bank that's interested and says, yes, we'll lend to you, but only for our assessment area. And so it's these 7 counties out of the 80 counties that you serve, and the money's restricted to those. And you get another bank and they're like, yes, but only for these 3 counties. And it's just really hard to manage, and starts to erode the goal that we set out for, which was flexible capital. So it's been interesting that because assessment areas drive CRA investing, and because the big banks tend to have, at best, scattered assessment areas in rural areas, CRA has not been as helpful in our market as I would have expected. So we're starting to turn to other either non-bank debt opportunities in order to get leverage, or at least non-CRA driven opportunities with banks, and beginning to explore that as a strategy to generate leverage and expand our flexible capital pools.
Yeah, thank you, Brian. I want to turn it now to Sarah to talk about collaborative lending and then also about manufactured housing. From what I understand, NeighborWorks network members are co-lending and finding ways to share risk at scale. Could you describe what some of these collaborative lending models are, if you can, and what it takes to stand one up? And then you've talked a bit about manufactured housing as the most underutilized affordable housing resource in the United States. So what does it take to deploy manufactured housing seriously as a solution, if you wouldn't?
Sure. And I do want to just start by saying that I echo what Brian was saying, is we've found the same thing in terms of our goal is also finding flexible capital, and capital that's often, especially in lending products, underwritten perhaps a little differently. It might be considering very different elements. And so we've had much the same experience, whether it's in the CRA landscape or really continuing to work to find flexible capital. So on the lending models in our network, we have approximately 80 CDFIs out of our 240-ish, so about a third of our network are CDFIs. We have more lenders that are not CDFIs, but they also are lenders, and probably about half the lenders do really work intently in both the residential mortgage space and lending products, as well as in small business loans, different parts of workforce development and economic development. We have a couple fairly large lenders. I think they're probably also part of Nadia's network, especially around in Appalachia and in the Delta, who use hub and spoke models. So this is something where they even have their own, the one in Appalachia has its own small network, and it's really providing that sort of core, that hub, in putting lending products, putting loans out into smaller organizations or supporting smaller organizations with back office operations, with whatever it might need. But where small organizations might not have the capacity, might not have the capital to underwrite and to move a lot of loans. And so some of the larger ones within a region often serve as that hub. And we've had that in several places. And I think just in terms of collaborative lending pools, that is a model that is very popular and of interest in rural areas, because often one small area alone might not garner as much of attention as if perhaps 5 or 8 organizations who are in a huge region of the country or a region of a state, who might be able, if you pool all of their capital together, to get more attention from a larger source of private capital. On the manufactured housing side, the GSEs, both Fannie and Freddie, have 2 products for manufactured housing, specifically as real estate, as titled real estate. There have been, through some of the duty to serve adjacent activities and nonprofits working with the GSEs, just sort of saying, hey, how can we provide, whether it's lending products or information around different types of factory-built housing, and help continuing to figure out how to finance this as real property. If you know the history of some of the factory build, it was manufactured housing going back into the mid-20th century, really taking a couple very large leaps in about 1976, and then in the 90s of uniformity, a uniform building code, HUD standards. Today's manufactured housing and larger, even into the factory built space of modular and structured insulated panels, it is absolutely not what people think of it. Where it was in the middle of the 20th century. It's not meant to be mobile. It is on foundations in a place. And so really recognizing that the opportunities for real property titling have been absolutely critical in starting to move this type of housing into a more accepted space, because the quality of it rivals stick-built in many different places and from many of the major producers and in industry. I also wanted to touch just quickly on how a couple examples, building on what Tom was saying about some of these programs, the federal programs that have been a hallmark of funding rural housing or making it available for purchase over the last decades. That's been changing recently. And so the nature of those programs is changing. And I wanted to throw out there that some of our groups, and I just think of 2 examples up in the Northeast region of the U.S. right now, who have really said, we want to try to be creating housing that is not requiring those subsidies. It's very hard to put a different capital stack together, but what they've been doing is really reaching out and creating private partnerships with private developers and GCs, maybe the one GC who's worked in that rural town or area for decades, and creating joint venture agreements where perhaps one of the staffs might have expertise in LIHTC projects and maybe cash resources available to pay all the pre-development costs. In some of these joint some of these joint ventures, it's often a fee-based development consultant. It might not just be a co-developer. And it varies within this JV of perhaps who has the final decision-making power and who's the owner and the managing member of these. But what we're seeing is these 2 examples in the Northeast where, again, very seasoned private developers from these communities or a region of a state are then coming together and working with some of the most seasoned nonprofit developers in a state to figure out how they can both best complement each other and how they can use the advantages of their positions each to make sure that they can put market rate, but often missing middle housing out on the street to help serve the community members. Because otherwise, sometimes private developers are not interested in coming into rural. The density is not there, the ROI isn't there. But with these joint ventures have really resulted in quite a few very specialized housing communities where, and again, as I mentioned, some of the middle income housing, but it's shared site work and planning, it's shared political support, It's shared all of these different pieces that help make their models very targeted in the geography, scalable, and replicable. So that's just a couple examples of where our network is having to pivot because things have been changing at the federal program level.
I just want to hop in here 1 second, Chris. Just to remind everyone that there's a Q&A section. If you want to ask a question, please put it in there, and we'll try to get to it the last 5 to 10 minutes. So that's it. Thanks.
Thanks, Chris. Yeah, no, thank you, Sarah. I think to kind of wrap up this financing section and sort of continuing on that thread, I wanted Nadia to talk about kind of what mix of grants, loans, and equity she sees work best, and kind of what programs she's seen the most activity with, and given the current policy environment, what you might be most worried about losing. If you could just kind of touch on that briefly.
Yeah, I appreciate the opportunity. I think for the most part, I think what Rural LISC and LISC does well in rural places is we try to help our partners and those who need this support with pre-development funding. A lot of times that cost of that we talked about with infrastructure, with site selection, with fees and environmental reviews, that's money that you just have to have in your pocket somehow as a nonprofit entity trying to build housing. And so we come in with affordable pre-development loans. Often we call them recoverable grants. So it's an investment not just on the housing development potential, but also the entity to find a way to get those units built. And so it's very favorable terms to allow for the unknowns that might happen as developers pushing that forward. And it's crucial funding that allows for the public dollars and other takeout financing to come in eventually. And so I would just throw out that's one sort of sweet spot that we try to support, in addition to lines of credit and loans and permanent financing and all of the other sort of critical parts of that capital stack as a development's moving forward. What I find most challenging now is just how unstable the public dollars are, which are such a critical part of affordable housing development across the country. I mean, we flat out, you need USDA and HUD funding to support affordable housing development. And that's just been the hardest unknown for the last year and a half. It's a challenge that we have to face on the day-to-day, not just structuring our developments with enough time to account for this uncertainty, but also the advocacy and the storytelling and the meeting in Washington, D.C. to explain why these programs are so important and so catalytic in rural places. Public funding is a key part of all affordable housing development in urban markets and in rural markets. But as it's already been described, public funding is really all that's available in rural markets, most of all. And so it's one of those, without one, you can't have the other. Without USDA investing as they have for their history in rural housing development, you can't get the smaller investments from state, local, private sources to fill the gap that USDA and other public funding has already provided. So I do want to stress that in this time, more than ever, and I've been doing this a little while, not as long as Self-Help Enterprises or Center for Rural Affairs, but there's always a crisis. There's always a reason why we're advocating and showcasing the incredible work that happens with these public dollars. But now more than ever, we're just seeing this level of uncertainty that will have a long-term effect on the number of units that are being built in rural places across the country. Not getting funded today means units won't be finished 2 years from now, 3 years from now. Not an uncertainty around today's dollars will affect a developer's ability to start the process and incur costs for developments that they're planning in 4 years from now, 5 years from now. And so it is a long-term potential impact that we are dealing with at the moment. That is something that kind of keeps us up at night. At least it does for me. My parents built a mutual supply home. I know very clearly the impact and value of the USDA loan that parents received and how it changed my family's trajectory. And I feel like that's something that we're sharing with our elected officials and our advocates in the federal government to understand the value of those public dollars.
Thank you so much, Nadia. This is actually a good time to turn it over to the questions because many of them are related to financing gaps and also public policy, which was going to be our wrap up. So the first question that I want to bring to the group is from Lauren Williams, and her question is, are there any go-to LIHTC syndicators or investors kind of focused on preserving rural housing? And she notes that they have several deals and they're struggling to find a willing tax credit investor. So I don't know if anyone has thoughts on that.
Well, I just might mention that there are several national nonprofit equity aggregators, if you will. One is Enterprise Community Partners, and they're affiliated with LISC. They were created by LISC. The other is NEF, the National Equity Fund, which came from who did they come from? I should know that, but
they're affiliated with LISC.
They're the LISC. Okay, yeah. I got that backwards.
Yeah,
but both of those, and we've had recent experience with Merit Capital, who's also a nonprofit aggregator. They basically get others to invest with them, but I would say getting with somebody who understands where to attract capital is really important. And I think all those three do that well. I think they match investors to deals. And especially if you're working in a nonprofit space, I think it's worth reaching out.
Yeah, and
go ahead.
To clarify, that one of the things that we try to do is bring like National Equity Fund or another nonprofit syndicator in as early as possible in a deal, because then you do then get the time it takes to sort of get all the ducks in a row. They're also able to provide technical assistance and help get the word out about this opportunity that might be coming for an investment or tax credits and get the funding together. And so that's the other thing I recommend to folks is talk to low-income tax credit syndicators, direct bank investors, if the geography is right for them, as early as possible, because those are the way to sort of get the on-ramp in a more realistic time frame too. So that's one thing I advocate for.
Yeah, I was just going to note, whether it's lip service or not, a number of major banks I know do have rural. They are more focused on rural than they have been in the past. So, yeah, so the next question is actually related, and it's from Michael O'Mara. And how do you see the new Rural Opportunity Zone 2.0 legislation being a resource, if at all? So I don't know if anyone has anything to say about that. Actually, when Chris and I first considered this topic, that was sort of kind of how rural came to mind for me. So I don't know if anyone.
I'm happy to jump in,
Sure.
Unless you want to. I think for us, what we're seeing is that it's a complicated, very nuanced program, but it always has been. And so it's this idea of finding kind of the perfect example and then doing it as like a first and then sort of building from there. And so I would say I'm more optimistic about it, but I tend to be an optimistic person than I was for the original Opportunity Zone work. It's just, it is a very unique and complicated program. And so it's just, I think it needs to be tested and then challenged a little bit in order for it to factor into the realities of rural development. But we're not going to let it sit.
I keep asking this question of people that are way smarter than I am on financial matters, and nobody's told me how it's going to help yet. But I would say that 5 or 6 years ago, the same could have been said about new markets tax credits.
Yeah.
And we're now using them fairly regularly on single family deals. They're expensive and they're complicated and they take too much of your own capital up front, but they can close a significant gap and make your deals work. So I'm going to hold out hope too. I'll be optimistic with you, Nadia.
And yeah, I can just round that out a bit. It was around in the first round in 2017 and 1.0. I think this does have some program changes that are more rural forward. But what I think, based on what we saw in round one, is it really works well where there's already investment interest and there are developers clamoring in a space. And I think the question is, how many times do we practitioners see that in rural communities? And that I don't see has changed between 1 and 2. There are better tax credits with the changes in the program from 1 and 2 for rural, which is a really good step forward. I just wonder will it really be able to reach things that already weren't of great development interest, and there wasn't this ready to go parcel with people clamoring. So we're all watching with great interest, and so I will join the optimism bandwagon. But to Tom's point too, I think all of us have heard no one's been able to really play it out yet, and we'll just have to sort of see how it evolves.
Oh, thanks. The next question is about sort of clean energy infrastructure, which I know Brian and I at least have been very deep in green lending. So I don't know if anyone has anything to say about sort of the current state of incorporating clean energy infrastructure into projects. As I think most people on this webinar know, certain funding sources are in flux or less available at this time. So I don't know if anyone wants to chime in on that. And then we're short on time. So the next question is about the SARAH program, and if you've seen LITech coupled with SARAH, and just anything you might have to say about that. And then I think we're going to be short on time. So
I can jump in on the question around funders being amicable to incorporating renewal. I think what I've seen is public funding has already had that as a priority. A lot of times you'll see that as public funding dollars want to see net zero energy and then LEED certifications and that sort of thing. But what we're also seeing, at least from my experience and my vantage point, is private dollar investment interest in this in clean energy and within housing developments. I actually think, and again, I am a very positive person, but the Greenhouse Gas Reduction Fund program created an environment where people were thinking about how we could maximize on billions of dollars in investment, and some really incredibly innovative ideas came out of that. And I don't think that those ideas have died because the program is in somewhat of limbo. I think what we're seeing is that there's private funding sources that have this already as a priority, saying, can we test out that concept that you had in this very specific market? Again, geographically focused and more like a test and learn structure. But I think we are seeing a lot of openness to these kinds of conversations about ways to maximize on what might have been possible with GGRF, but really being more strategic in terms of geography and size of scope to prove the model a little more than so I'm hopeful.
Yeah, thank you. I don't know if anyone else has any closing remarks or anything to say before we wrap up. Well, I just want to thank everyone for joining this webinar. It was really great. I think Chris usually sends around a recording for those who signed on. So
I'll do it.
Reach out.
I'll do it.
Yeah, you can reach out
It'll
to
come out
me or
Monday.
any panelists if you want to learn more. And thank you to everyone who joined today.
Very good. Thanks for having us.
Thanks, everyone. Have a great day.
Thank you.
Thanks, Kristin.
Thank you.
Thank you for listening to Beyond the Resume, a Jackson Lucas podcast where we take a deep dive into the career journeys of some of the top minds in real estate and equip you with the knowledge to move forward in your path towards the success you've envisioned. Make sure to like, share, and subscribe to Beyond the Resume. We're grateful for your support. All episodes of Beyond the Resume are brought to you by Jackson Lucas, building inclusive and diverse businesses through talent acquisition. Visit us at jacksonlucas.com